Can a US company own a Canadian corporation 100%? When US companies expand into Canada, one of the first strategic decisions is whether to create a Canadian corporation. A common question arises immediately. Can a US company legally own a Canadian corporation outright? The answer is straightforward. Yes, Canada allows 100% foreign ownership of corporations, including ownership by US entities. Unlike some countries that require local shareholders or directors, Canada generally permits full foreign control, with only a few exceptions at the provincial level. Understanding what's allowed and what responsibilities come with that ownership helps US companies structure their Canadian operations effectively. Federal rules allow full foreign ownership. Canada's federal corporate statute, the Canada Business Corporations Act, CBCA, allows non-resident individuals and corporations to own a corporation entirely. There are no nationality restrictions on shareholders. This level of openness is one reason Canada is considered a business-friendly environment for US companies. However, federal rules and provincial rules differ, particularly around directors. Director residency requirements. While shareholder ownership is unrestricted, some provinces require at least one Canadian resident director. Director residency rules vary. Ontario, BC, Nova Scotia, New Brunswick, PEI, Quebec. No residency requirement. Alberta, Manitoba, Saskatchewan, Newfoundland. At least 25% of directors must be Canadian residents. Federal incorporation also used to have residency rules, but these requirements have been eliminated. If a US company wants to avoid residency requirements, incorporating in a province like Ontario or BC is often the preferred choice. Tax implications of full ownership. A Canadian corporation is considered a separate legal entity from its US parent. This creates several tax implications. The Canadian corporation pays Canadian corporate income tax. Dividends paid to the US parent may be subject to withholding tax reduced under the tax treaty. Transfer pricing rules govern intercompany transactions. The Canadian corporation must maintain separate books, payroll accounts, and GST/HST registrations. Full ownership does not shield the corporation from Canadian tax requirements. Operational advantages. Full ownership offers several benefits. Clear control over Canadian operations. Stronger credibility with Canadian clients. Simplified onboarding of Canadian employees. Easier banking relationships within Canada. Ability to scale operations independently of US activities. For long-term expansion, a Canadian corporation is often the most stable structure. A practical example, a US software company wants to open a Canadian office to support clients in Toronto and Vancouver. To simplify employment, banking, and tax compliance, the company forms a Canadian corporation wholly owned by the US parent. The corporation registers in Ontario, where there is no director residency requirement. It obtains CRA accounts, hires a Canadian team, and begins operating as a local business while remaining under US ownership. This structure gives the company full control while ensuring compliance with Canadian law. Final thoughts. A US company can absolutely own a Canadian corporation 100%. Canada welcomes foreign investment and allows complete foreign ownership of corporations as long as director residency requirements, where applicable, are satisfied. With full control, clear tax rules, and strong legal protections, this structure is ideal for companies planning a long-term Canadian presence. If you'd like more insights delivered in the same straightforward style, you can explore our website. If you require assistance with Canadian tax matters, our team is ready to provide reliable professional support. Please contact us at 416-283-8774 or visit theaccountingandtax.com for more information. And if you found this video helpful, don't forget to like, subscribe, and share.